Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today, right here at the end of May. And we are wrapping up pretty much halfway through the year here, starting next week. And really looking excited to the back half of this year for sure. We'll talk a little bit about why that is, but a whole bunch of data this week. And we got a lot jam packed into this particular show. If you're new to the program, welcome. Please like, share, and subscribe to the Shepherd Wealth Management Podcast for your friends, family members, and coworkers. Got a lot of great feedback, not just from customers, but from people that are just enjoying the program here. And the primary reason why we're here to do all this stuff, if you are new, is simply to fill in some of the big holes that we believe a lot of the news media tends to leave out. And I'll give you a simple example of that. News is front and center most often in every presidential cycle, but certainly right now. And everybody has a smartphone these days, and you're getting all this information in real time very, very quickly. The news is doing a good job of staying in business. But what I mean by that is they're a for profit entity, and the way that they drive their revenue is viewerships. They're trying to increase their viewerships, of course, given that a lot of people are kind of shifting more towards programs like this on YouTube and other podcasts across all kinds of different media outlets, Spotify, etc. And the news does a good job of bringing things to your attention that is, and most times, fearful. There's a very specific reason for that. The news should bring important news to your attention, good or bad, fearful or happy. But specifically, the reason for the more fearful headlines that you're seeing out there has a lot to do with this topic called behavioral finance. And you can get a PhD in this topic at pretty much every major university these days. It's very fascinating to me. And it simply just shows that human beings, investors, are highly emotional, especially when it comes to things like their money and investing in the stock market. The news also understands from behavioral finance that humans, investors, they feel losses twice as much as they feel good emotionally about making any amount of money. And that's the reason why you're seeing more fearful headlines in pretty much every presidential cycle. It's not just this one. This seems to be a little exacerbated to me. Um, but that's the reason why those headlines are a little bit more fearful in their tilt in their message, because it keeps the human being, the viewer, twice as engaged as they would about some sort of happy news. So I'm all for making profits. I have no problem with the news doing their job to stay in business. What we do, what I think the news does a poor job of, we fill that gap here at the Shepherd Wealth Management Podcast, is helping viewers and investors, other humans, understand that yes, this is potentially scary. And here's the reason why. But oh, by the way, we've been through something like this over the course of the last 100 years, last 75 years in the market. And here's how the market looked 6, 9, 12 months later. Here are the sectors that did well. Here's the ones that did not. The market's made of humans. And the best part about this is, even though we cannot control a lot of things when it comes to investing, the one thing that we can kind of hang our hat on from a data perspective is that the human being hasn't changed all that much in a couple thousand years. It's probably the only predictable thing when it comes to looking at information to help make decisions, buy, sell, or hold within your own portfolio. So that's been a big advantage for us here and our clients at Shepherd Wealth Management. We use a long-term, modern portfolio theory type of approach towards building an asset allocation to meet the needs and goals of our customers, but to fill in the positions, the weightings, what sectors, how much, how little. It's always filtered through this lens of history that we look at the market. And that's exactly what we're going to be talking about here yet again today. So, a lot to get into, and I'm excited to share all this with you. But I think it would be remiss if we did not start with the headline news, really, of the week, in my opinion. I got some really interesting data here this morning as well that we'll talk about regarding inflation. But NVIDIA, the largest chip maker, the trillion-dollar giant that they are, just had another mic drop earnings announcement earlier this week. And NVIDIA reported revenue for the first quarter ending in April 2025 of $44.1 billion. This is up 12% from the previous quarter and up 69% from a year ago. I mean, if you look at their non-GAAP gross margins of 71.3%, I mean, their only problem at NVIDIA is that they cannot make their chips fast enough. And with over 70% profit margins and earnings that are growing double digits quarter after quarter, nearly 70% from a year ago. I can't really think of a more envious position for Jensen Huang, the CEO, compared to everyone else in the S&P 500. Now, of course, with investing, past performance is no guarantee of future results, and investing involves risk, including risk of loss. You can't guarantee that all this past performance, not just for NVIDIA, but everything that we look at the market through this lens of history through, you can't guarantee that that similar performance is going to happen for you or in the future, but it certainly does put things into perspective, and it definitely gives you a really good look at what the risk and reward might be for the decisions that you might make as an individual. So this is just another mic drop earnings, and the stock was up, of course, about 6% when that news came out, which was fantastic. And you're seeing a sell off here today due to tariff headline risk yet again. Even though we got some excellent economic news this morning as well, which I will get to. But the stock is just unbelievably amazing. And I know that our clients are certainly benefiting from the growth of this company over the last several years. So definitely very excited to be a NVIDIA shareholder. Their story and outlook was confirmed in this particular, earnings announcement. Given that you're seeing all the other major data center type of companies, the Amazons, the Microsofts of the world, the Metas, Facebook, all of them, they continue to spend and they continue to spend on NVIDIA's chip, given that it is the single piece of technology needed, at least at this point in time, to do the types of things that artificial intelligence is hopefully going to be doing, and it is already doing in some ways for businesses across the world, not just here in the United States. So very, very excited after that earnings announcement, and very, very excited to be a shareholder of this fantastic company. However, once we get into the news that came out after, on the very next day, we got that NVIDIA announcement. We had a lot of information coming from the White House and other federal judges regarding tariffs. So I'm going to talk about a little bit about that today. But before we do, um, just a lot of good stuff this week, even though the markets, the major averages are still slightly negative year to date. And we've got a lot of clients, of course, they're spread out across the United States. And some have asked, uh, they've asked us why stocks have moved up so sharply on what seems to be benign news. And to us, this reflects both sizable perception gap, meaning that investors are more skeptical of fundamentals, and positioning gap. And this is, in our view, one of the most hated market rallies of all time. And in a meeting with a whole bunch of clients, it's very clear to me that it's not just the most hated rally, but it's given that V-shaped recovery that we got after all the selling happened from mid-February to about the middle of April, and we're getting this violent V-shaped recovery, about 3 or 4% from all-time highs in the S&P 500. This is very, very similar. Again, looking through a lens of history here, post-COVID, March of 2020 through June of 2020, big rally, big recovery from the news that we all know came out in March regarding COVID. The second time that we can compare to is the Fed rate hike cycle in 2022 from November of 22 all the way through the summer of 23 before they finally started to reduce interest rates. And in those other instances, investors were very skeptical of the V-shaped bounce that they were looking at that time. And ultimately, investors did end up turning constructive on the stock market, meaning buying S&P 500 names or the S&P 500 itself. And this happened after the S&P managed to close above its all-time high. So in other words, we believe if investors repeat similar type of behavior from prior instances, that we can look back and see big market drops, big V-shaped recovery, a lot of skepticism, just like I talked about in those other two instances. We would believe, based on that information, that the S&P 500, once it closes above its prior high of 6,120, that a lot of investors will start to get constructive on buying the S&P 500 and the names inside of those. But the drivers of this most hated rally are as follows. There's a sizable perception gap. In other words, the tariff bark has been worse than the bite, meaning that it's not showing up in any of the data, at least not so far. And we're going to talk about the recent economic data that we got here this morning that aligns with that. Secondarily, hedge funds. We talked about this in a prior podcast, I believe. Hedge funds have increased their short interest to the highest that it's been in quite some time. So the quote unquote smart money is short the S&P, and they're definitely not too excited about losing money during this V-shaped recovery, but they remain short. And the third reason is there's $7 trillion still sitting in cash. I mean, this is more cash than we're talking about in 2008, and that was the worst thing that's happened in one market year. Um, you have to go all the way back to 1929 when we had breadlines in this country due to the Great Depression. $7 trillion of cash sitting on the sidelines, missed out on one of the best buying opportunities we've seen really since maybe COVID, March of 2020, when the market lost nearly as much. Matter of fact, that loss in March of 2020, the S&P, that was the fourth fastest drop in the S&P 500 since 1950. What we just went through from mid-February all the way through mid-April was the fifth fastest drop. So again, we talked about this during prior podcasts, and obviously there's never a guarantee, but human being tends to repeat their behavior quite a bit, like we've discussed. So that 7 trillion on cash is eventually going to have some buyer's remorse. We think a lot of that gets put to work once the S&P gets above its prior high of 6120. Fourth reason, investor outlook is now better today than it was in February 2025. We got some consumer sentiment data yesterday that was very positive, first time in quite some time, going back to February of this year. Fifth reason, tariff visibility is becoming a little bit more visible. We understand that tariffs are going to likely stay in place at some level, and that's becoming a little bit more clear each day that goes by. Another reason, tax and deregulation is visible. Obviously, there's a big tax bill that has a lot of deregulatory goodness to it, and that's certainly a benefit for stocks. Sixth reason, U.S. Consumers survived the fifth major stress test. As I mentioned, that was the fifth fastest drop in S&P 500 in quite some time. And last but not least, the Fed will become more dovish either late this year or into 2026, which of course is a good thing for stocks. And we'll hear from the Fed chairman in just a couple weeks here in June. So we got a lot of information here regarding tariffs, but the bottom line is this is one of the most hated investing market rallies of all time. Now we still are very bullish here at Shepherd Wealth Management for a lot of reasons, and the primary reason is what we talked about during our last podcast, and we've written to clients about multiple times. You just went through with the fifth fastest drop in S&P 500 since 1950. The four other times where it was worse was Black Monday, um, October 1987, happened twice in 2008, and then happened March of 2020 with COVID happened. And in all four of those instances, 12 months later, the S&P 500 was positive. In other words, there was a 100% win ratio in all four instances. If you were to buy as everybody else is selling and in panic mode, in fearful mode, if you were to buy 12 months later, you're seeing a positive result. So, in other words, for a long term growth investor, really isn't a lot of risk putting your money to work under those circumstances. But what was the reward? Well, the average return over those four prior instances where the market lost more money in a faster clip than what we just went through here from mid February through mid April. The reward for buying on those other four instances was an average market performance in the S&P of 34%. Now, these are averages, could be higher, could be lower than that. But to us, that's a much better reward for buying the same stocks that we would have wanted to own anyway in January by buying them during that sell off, especially for the long term growth investors. So, using the market historical data certainly helps put things in the right perspective because, of course, if you're just paying attention to the news, or a guy like Jamie Dimon here today, the CEO of the largest bank on the planet, JPMorgan. JPMorgan is a great bank. We hold that for our customers as a financial holding in their portfolio, at least for most customers. I have a lot of respect for Jamie, but Jamie has been a phenomenal banker over the course of his career. He's always taken a negative viewpoint on the market. He's always looking for risk out there, and that was no different here today with his commentary that really caused the sell-off that we're seeing here as we go through this afternoon, this Friday afternoon here, right at the end of May. Investors are taking his comments and digesting it with the other data that we've got this week, and they're selling their shares here, I believe, due to a lot of the things that he had to say. And he is right to point out there are risks, and he points a lot of them out. He believes in most instances that those risks are going to be a likely outcome, but you got to understand where you're getting that information from. He's a banker. Bankers are risk averse. They're one of the most risk averse group of people I've ever seen in my life. And that doesn't make them bad people. That probably makes them a pretty good banker, especially after what happened in 2008. So I don't have an issue with his perspective. I'm just saying that I think the news would do investors a great service by just bringing that information to their attention, and allowing them to do what they would like to do with that. But effectively, a lot of investors feel the way that Jamie Dimon does. Otherwise, you wouldn't see the $7 trillion that you're seeing in cash right now. But I'm quite confident based on what similar circumstances have provided us from a historical data perspective that investors should get engaged here, specifically as we get closer and closer to that all-time high in the S&P, which we're real close to it right now, anyways. And we do believe our viewpoint here at Shepherd Wealth Management is we will see new all-time highs in the back half of this year before we get to the end of December. Now, some of the economic data, kind of shifting over to that. Yesterday, Thursday, May 29th, we did get initial jobless claims, 240,000. The market was expecting 230,000, so a slight uptick in initial jobless claims, but we're still under 250,000, which is a pretty key historical watermark there. So something to keep an eye on, but definitely not an issue here regarding the unemployment rate. No major concerns there. GDP. And by the way, I don't know of any large major corporations that are looking to lay off substantial amounts of workers. GDP was revised, so that revision came in better. GDP was only down 0.2% compared to what economists were looking for 0.4. And in the prior reading a month ago, it was 0.3. So better GDP revision data. But most importantly, and this has not really been talked about in the news at all today, because everybody's focusing on not just the comments from Jamie Dimon, the CEO of JPMorgan Chase, but they're also scratching their heads a little bit regarding the trade, we'll call it negotiation between the US and China. And that seems to be causing a little bit of issue here this morning as well. But today, the news should have been all about the Fed's favorite measure of inflation, what they call PCE, and specifically core PCE. Now, the PCE index came in line with expectations, 0.1, which is great. But the PCE year over year number came down. Analysts were looking for 2.2. It came in at 2.1 PCE year over year. And the prior reading, by the way, was 2.3. So inflation is falling, and that is as about as close as you can get to the Fed's target of 2% long-term inflation expectations. But when we look at the core component of PCE year over year, that came in lower again. Last month, it was at 2.7. This month, this morning's reading 2.5. So we are, in fact, still seeing disinflation, not inflation, which is what you're seeing a lot of in a lot of news media outlets. That tariffs are inflationary. They're going to cause higher unemployment, higher prices, and ultimately a recession. That might be how a lot of people feel. Again, they're acting with the cash that they have on the sidelines. I'm sure a lot of people feel that way. But the reality is it's just not in any of the data. And if you're only allowing the news media to determine not just your feelings, but how you're going to make decisions, I would highly encourage you to take that news information and dig a little deeper. Take a look at similar market circumstances in history, try to get an understanding, the right perspective of the situation that you're dealing with here. And if you are a long-term growth investor, look at the data through that lens as well, as opposed to just how you feel in the moment. And if you can't control the emotions, definitely seek out some help. It's exactly what we're here for. You can call us or go to our website, shepherdwm.com, and there's all kinds of information about how to reach me, call, text, or email. We'd be happy to have a thorough discussion with you. But the reality is you're not just seeing it in the news media, you're seeing it across every sort of media outlet that you can find. And I say that very confidently because we consume all of that data, as you can imagine here for our customers. That's part of our job is to get a good understanding of what all sides um, are concerned about for their viewers. And one of those that we've talked about here over the last several shows has been Barron's. And Barron's has been around a long time, very reputable outfit. But they have a lot of bias, just like every other news media outlet does as well. And I wanted to call some of that out. Not picking on Barron's again. Love Barron's. Been a Barron subscriber for quite some time. But right at the front, page 7 of the most recent Barron's report that came out on 26th of May, uh, this is the headline: "The stock market had a bad week. It's your fault." And in the very first sentence, this was written by Ben Levinson. I think I'm pronouncing his last name correctly. I think he has a little bit of a bias if you start to read this. And I don't think he's a big Trump fan at all. I don't know that for sure. That's just my view of how he's writing this. But in other words, he's saying this quote, "Oh, Donald." That's how he starts this. And second sentence, quote, "Just when the stock market was getting comfortable with your agenda again, you had to go and shake things up." Further quote, same article. Just when you thought things couldn't get much better, they didn't. I mean, I can go on and on across all of this. Yes, there's a lot of emotions going on right now, and the news is bringing things fast and furious, and it's coming from the White House fast and furiously. So I understand. It's a lot to take in for certain, and it might not make everybody feel great. But if you remove the political bias, and how do we do that? I want to understand how other human beings have behaved in similar circumstances. The market doesn't care. Republican or Democrat has averaged about 10% approximately over the course of the last 100 years, regardless. Now, these pundits and the financial media, they're allowed to have their opinion. They're allowed to feel however they feel. And certainly they're going to continue to write and get paid to continue to do their job to the best of their ability. But you got to kind of understand where their perspective lies, and their perspective is likely going to have some bias to it just because we're humans. So if you can't really control all kinds of stuff when it comes to investing, and you can't, we can sit here between now and Christmas just rattling off all the things that you'll never be able to control when it comes to investing your money in the stock market. But the one thing that Warren Buffett would say is the most important thing to have control over, the number one reason why the best investor of all time, Mr. Buffett, said that the individual retail investor does not achieve the results that they're looking for consistently over time, is they have no control over their emotions. So how would you gather control, especially if this isn't your area of expertise, right? You're not maybe a finance type of person. That didn't wasn't your background, wasn't the gift that God blessed you with. Well, how can you get control of your emotions knowing that you need to be invested if the goal is to retire one day or to provide some sort of legacy for your family, or maybe invest in a business, etc. That those are just several reasons why people are investing in the market. Could be a lot of other reasons for you personally as well. But if you got to get control of your emotions, because Warren Buffett said that's the number one reason you won't achieve the results you're looking for consistently over time, for us and our clients at Shepherd Wealth Management, for me personally, the best way that I've been able to get control over my emotions is looking at that historical data and allowing that to put us or put our mindset in the right perspective, because that data is not Republican, it's not Democrat, it's not an independent, it doesn't vote, it's just data. It is what it is. And it helps put things in the right perspective, like I mentioned earlier, from a risk reward perspective. And once you have a clear understanding of what the risk and reward is, you've now done the most important thing. You've removed emotion from the equation. And now you're looking at those probabilities of what the market's going to do historically over similar circumstances 6, 9, 12 months later. It's not a guarantee, even though those other four instances that I rattled off, the market was positive all four times. In other words, 100% win ratio. So this would have to be the first time in 100 plus years where the market bucks that trend, right? It's not a guarantee. That could happen, but I'd be willing to take those probabilities for the long-term growth investor clients that we have here. And it's certainly been a major driver of success so far this year. On average, our customers are up more than 10% year to date net of fee. Some are higher, some are not as high given their risk tolerance. In the market, the S&P is basically flat year to date, slightly negative. So we're very, very proud of that. And we've been able to repeat this over and over throughout the course of the last 4 years that we've been in business. We'll be in business 4 years coming up here on June 4th. So next week, we'll be a 4-year-old company, started from ground zero And now we're managing about $140 million for our customers across about 15 states here in the US. We're very proud of the results that we've been able to achieve. And it's not because, I'm some sort of financial genius or my business partner, John, he's some sort of guru. We're smart people. We might be a lot of things, but dumb isn't one of them. But we understand that, there's certainly other people on Wall Street that probably are a little sharper. There's no question about that. But you don't need to have a 180 IQ to be a really good investor. What you need to be able to do, according to Warren Buffett, is be able to control your emotions. And this has worked really, really well for us to have a process that takes emotion away from your decision making process. All that does is put you in the right perspective, make it very clear of what the risk and reward is, and much easier to make decisions under that framework, as opposed to just reading your Barrons or whatever process you go through to gather data. And I wanted to give a couple more examples of this in this most recent Barron's paper that I received, or I do receive every single week. Um, Looking for that article. Oh, here we go. So, no surprise at all. When you get the fifth fastest drop in S&P 500 history, one of the things that tends to happen is annuity sales go up a lot. And by the way, just as a casual American, as you're traveling around this summer, hope you enjoy your summer and safe travels. But some food for thought. Maybe as you travel around into these cities, I'd be willing to bet you that in all cities that you go across, or damn near all of them, the tallest building in that city is going to be an insurance company. It's either an insurance company or a health company. There's a reason for that. And even in Cincinnati, this isn't the biggest city in the world. I love the Queen City. This is definitely home. Tallest building in Cincinnati is Great American Insurance. So I'd be willing to bet that as you travel across the country here this year, check that out. See if you have a different perspective than I do. But this is again in the most recent Barron's, page 20. This is the headline: Annuities are hot sellers for volatile times. The most popular annuity product against all or some losses while offering either fixed yields or returns linked to stock market index. This is a bunch of bull. Now this data is true. Annuities are hot sellers in bad times. You go back to 2008. If you get a presidential change, depending on your perspective of that change, a lot of annuity sales happen during that as well. And it's not that surprising. Again, you can go back to behavioral finance and it helps you understand very simply that humans are hardwired with a lot of emotions, but the two biggest drivers for investors are fear and greed. And then we feel losses twice as much as we'll feel good emotionally about making any amount of money. So we are risk averse by nature. So whether it's our political bias sometimes, whether it's our fear of the unknown of what could happen with tariffs and trade negotiations and tax reform and deregulation and crypto, people just throw their hands up and say, you know what? This sounds good. And it always does. Every annuity that I've ever come across, it sounds awesome. It'll sound something like, hey, Ezra, I get it. You're really concerned about tariffs and the economy and the future path of the Fed and all that. We got a product at our insurance agency that I represent. They'll guarantee you in quotes. They won't say it in quotes. It'll be a very smooth, hey, this is going to guarantee you whatever, 4, 5, 6%. Um, but what they're not telling you is it's guaranteeing a certain amount of income that you can take off of that. They tend to leave out the fact that it's a very illiquid investment other than the withdrawal rate that they're allowing you to take, right? And if you want to access that money in a bigger way before the contract maturity date, which is usually 10 years, you got to pay a big penalty. And they don't help you understand that those annuity products are highly feed. It's not just like an average 1% management fee. There's generally underlying investment fees, mortality and expense fees, all kinds of rider fees. And you just get this illiquid, highly expensive product that does protect the principal in theory, but it does not guarantee you, whatever 6, 7, 8% return every single year. What they're simply saying is that if you had $1 million and they guaranteed a 8% return, well, you're going to have a 1,080,000 right at the end of that particular calendar year. you can take a withdrawal on that new number, 1,080,000. If it goes up again another 8%, it's the same thing. You get to take your 4% withdrawal of this supposedly bigger number. But if you want to go take all that out, you can't, at least not without paying substantial fees. In some cases, as much as 10 to 20% just to get out of that product before its actual maturity date. And they sell the most when people are at their maximum fear. That's exactly what these things are. And that's the reason why the tallest building in every major city that you'll see as you travel around the country this year is likely going to be an insurance company, because an insurance company is not a human. They have humans working there, of course, but the company itself does not have a heartbeat. They have a social security number, a tax ID. They're planning on being around for as long as there's human beings walking around on this planet. Therefore, they are certainly long term growth investors. They know that you can't access that big annuity investment that you made, at least not for the course of several years without paying a hefty fee. So they're going to quote guarantee you whatever 6, 7%, whatever you can find. Um, However, they don't actually allow you to access all of that money, but they will take that money and they are going to invest it in the market. And let's just say that they're taking on some stock exposure along with a little bit of fixed income exposure, and they know that you're guaranteed, let's just call it 6% for argument's sake here. If they can just buy the S&P 500, well, they're going to average 10% over the course of many, many years. Some years will be better than that. Some years will be worse than that, but the average will be about 10. And if they're, quote, guaranteeing 6 on most of these products, obviously they're pocketing the difference of 4%, and they're feeing the hell out of that annuity product that you have your money in every single year. On top of that 4% that they're putting in their pocket. And oh, by the way, when the market's up 20% like it is last year, they're still only giving you 6, keeping the other 14, plus they're going to feed the product. Sounds like a pretty good gig, actually. If you're really looking to make a lot of money, you might want to consider the insurance world. But the problem with that is at some point, you're going to have to repent. Um, from basically convincing people in their most fearful moment that it's a really good idea to put a big chunk of their savings, and in some instances I've seen their entire life savings going to something like this, and they don't have access to all of it. So what if an emergency comes around? Yeah, you get a guaranteed piece of cash flow, but what if something serious happened? You don't have access to that. It's unfortunate. And by the way, a lot of this stuff isn't even a financial product. You don't even need a license. You don't need a Series 7 or any of the stuff that I am required to have to do the job that I have here. I've taken a lot of those exams. You don't have to have any of that for some of this. Some of these products on the insurance side, you need no license whatsoever. It's not quote unquote a financial product. So all you have to do is be able to pass an annuity exam, which is 50 questions long. And it's so easy. I could probably help my 16-year-old daughter pass that with about 20 minutes worth of prep. You just need to understand what's the difference between a fixed annuity and a variable annuity. Pretty much the entire 50 questions there. I've taken that as well. It's pretty simple. So this is a program here, folks, that's going to help you not just control your emotions, but hopefully put some of this stuff into its proper context. And if this isn't an area of expertise for you, this isn't a area of strength, and maybe by listening to this program, you've finally come to realize that you are a highly emotional investor. You're a good person with a lot of goals, dreams, and objectives. In order to meet those, you might need some help. By the way, about 70% of millionaires in the United States are working with a certified financial planner or some sort of financial advisor like myself. That's a pretty good statistic there. I think that that's certainly something that maybe a lot of people didn't know. But there's a reason why some of the wealthiest people, understand that the decisions that they make are not only going to impact their life, but it's a really good chance that they can make an impact in the lives of others, either their family members, their community, their church, whatever it is that's important to them. The education that they hope to be able to provide, or make a big legacy from the college that they went to. A lot of reasons that the wealthiest folks in this country are working with folks like myself or somebody similar. And we'd be happy to do the same for you. This is right in our wheelhouse. You can certainly go to shepherdwm.com. We have a brand new website that we're very excited about. Looks very, very cool. You can find all the ways to get a hold of us. And the last thing to leave us with here before we part ways, since we spent some time on inflation and having that conversation, This is coming from a pretty reputable outfit as well, Investors Business Daily. And this was written just today, earlier this morning, by Jed Graham. And he does point out that the Federal Reserve's primary inflation rate, core PCE, fell in April to its lowest level since March of 21. However, the S&P 500 is slightly lower after President Donald Trump's China comments. And unfortunately, even though it's nowhere to be found in any of the data and inflation's following, and he points out this is the lowest core PCE inflation reading since March of 21. They go on to say this PCE inflation report showed most components of core inflation still look relatively restrained, a trend we expect to continue given the balance, labor market, and ongoing slowdown in wage growth. Still, the inflation data showed, quote, early signs of tariff induced boost to prices. It's not showing up here. Um, and more importantly, quote, much bigger increases in core good inflation probably loom as the cost of new tariffs are eventually passed on. So this is a lot of maybes, ifs, and buts here. It's not showing up in the data at all. So even though they lead off with, and this is Investors Business Daily, I'd say that this is just as prominent and respected as Barron's and all the other things that investors can get access to with the internet or just a subscription like we pay for a lot of this sort of stuff. They let off with, "Hey, this is great news," but they kind of get into the middle of this and say, "Well, we still think this is going to be bad." So without knowing, what these negotiations are how they're going to land, or when the tax and deregulation stuff is going to get passed and the impact that that'll have on the economy. So you're getting it from every angle, and you're hearing it from a lot of smart people, from Jamie Dimon to different folks that are in Barron's and Investors Business Daily, and whatever your favorite person is on CNBC or any of the news media outlets that you might get. You're getting information depending on the person talking. It's either very bullish or very scary. Not too many people in between. We fall in the bullish camp, but it's because of the historical data points that we've talked about here. And the reality is, it's going to be very difficult. You can't even begin a recession conversation with me when you have, price of oil and a barrel of oil is $60 or less. You're going to have a very difficult time convincing me that there's going to be a recession when Americans that want to work have a job with unemployment rate staying the same. Those are the two most important things that ultimately would certainly drive a recession if people were laid off and the price of energy went up substantially from where it is today. Those are really good signs of inflation happening. And that would certainly be a reason to be afraid of the stock market, at least for a period of time. So, with that being said, we covered a lot of ground here. As I think that that's pretty good for today's podcast. This has been a lot of fun for me to be able to catch everybody up, not on just data that's happened here this morning, but from some really cool earnings reports from NVIDIA this week. And I'm very excited for the back half of 2025. I think that this is going to be a pretty exciting 6 months that we're about to experience here. And I'm really looking forward to sharing our thoughts and perspective and the historical data that you're going to need to know to help you make good long term decisions for yourself. And if nothing else, certainly give you some food for thought to think about as you go about um, rebalancing and repositioning your portfolio for the back half of this year. So, with that, we'll be doing this again in another couple weeks. And hope you guys have a great summer. Stay safe, and we'll do this again in 2 weeks. Take care.